Great. Welcome, everyone, to the Investment Committee meeting for William & Mary. Today, the William & Mary Board of Visitors Investment Subcommittee is meeting virtually in accordance with Item 4.0.0.01.g of the 2020 Appropriations Act, which provides governing boards with the ability to hold meetings electronically without a quorum present while the Commonwealth is under a state of emergency. And so with that, I'd like to welcome everyone. Bryce, Joe, and the Optimal team, thank you very much for your preparation. And thank you to my fellow investment subcommittee members, Jim and Tom, for joining us. And then I know, Amy, you and your team have been busy at work in putting this all together. So thank you very much to all of us, to all of the folks that are attending. I'm going to turn this meeting over to Bryce. I know you sent across two documents, and I think that's the main topic of discussions, unless, Amy, you believe that we need to address anything else prior to us getting started.
No, I think that's right for today. I also would note, Mr. Chairman, that the Rector has joined us, so welcome, Mr. Rector.
Mr. Rector, in your honor, I wore a shirt instead of a t-shirt today, so just so you know.
Well, I actually have a real shirt on, so not a tie, but a shirt.
I see. Okay. All right. Well, thank you very much. I think it's nice to see you. All right. Great. Bryce?
Well, great. Thank you for allowing us to meet today with you. I believe I've been able to share the screen there. And like the chairman said, there are two topics for today. The first topic is to talk about just an update on the markets and the portfolio, how it's performing. Obviously, it's the end of the fiscal year. We've run those data points, so we've got an update and can provide that to the subcommittee. And then the follow-on item, the other topic, was addressing just the uncertainties in the market, the uncertainties in universities and endowments and so forth. So we wanted to spend some time talking about if any adjustments need to be made to the asset allocation. Since the markets have come back dramatically from the sell-off in March of coronavirus, this would be a good opportunity to reposition if any repositioning is needed. So those were really the two topics that we had to address today. Obviously, ask any questions if you want to. So this is the flash report. Our full quarterly report for the entire board will be ready in the next week or two, but given the short time frame, this is what's available at the end of June. So we'll quickly talk about the capital markets. I know the subcommittee is very aware of what's going on, but Robin, if you'll spend a minute or two talking about really what's been a quite remarkable first 6 months to the calendar year of 2020.
Okay, thanks, Bryce. So I don't have to tell this group what's going on with the capital markets or the economy, but to suffice it to say that in the first quarter, we had double-digit declines across all equity markets. And in the second quarter, pretty much all the equity markets are in double-digit gains. But two things that to point out, if you look on the third column here, it's your fiscal year to date, which is 12 months ending June 30th. So look at the 1,000 gross, Russell 1000 growth, up 23.3%. But the Russell value, 1,000 value, as you can see, was down 8.8%. So that is quite a disparity. We don't know when that worm will turn, but we know it will one day. So just keep that in mind as we balance the portfolio and look to see what, the differences between growth and value. The second thing is our outlook. It's not on this page, but, the S&P 500 outlook is 3150 to 3350. That's our outlook. Yesterday, the S&P closed at 3235. So we don't have a whole lot of room to grow or decline at this point. So with that, I'll turn it back over to Bryce.
Any questions on the markets or the economy? I know this group is very well astute and aware of what's going on, but it truly has been a remarkable run. I mean, we had basically the fastest decline of a market correction ever, and then we had the basically largest rise or quickest rise out of a decline. So obviously, a lot of the Fed's programs and other intervention, central banks around the country all played a role in that. In addition to all the medical background and everything that's going on with the economy, but truly a wide swing. And like Robin said, the difference between growth and value is truly remarkable.
Hey, Bryce and Robin, is it fair to say that if you're Amazon or you look like Amazon, you're in one market, and if you're everything else, you're in another market? It seems like I recall a day earlier this week when I think Amazon was up 6% one day, maybe by noon. Is it the case that if you say you deliver to everybody that's quarantining, like Amazon, you're hot, and if you're not, you're kind of average? Or it seems like there's two markets going on here, and you sort of reflected it in your growth versus value comment.
Yeah, so I think, you're talking about the growth versus value, and like Robin said, there are always time periods where different ones outperform, and they usually outperform for a period of time. What's different is, like you said, what let us out of this were a lot of the growth names. We thought this was of interest to you. If you can see in front of you here, here's the composition of that Russell 1000 growth index. And you can see basically, as Mr. Watkins was pointing out, between Microsoft, Apple, Amazon, and Google, Facebook, about those 5 securities make up about 36% of the index. And if you go to the top 10, including a few more, you're up to about 45% of the index. So that is the most concentration we've seen in that index ever, even more than we saw in the late 90s. What happens from here, we don't exactly know, but it definitely is something that we want to keep an eye on.
So this is FANG world, right?
Yes.
Okay.
And you also have a difference between the U.S. and non-U.S. because the non-U.S. is still suffering. Or the other way to say it, the non-U.S. has more potential right now.
Yes. Two sides to that coin.
Bryce and Robin, you folks touched on this, which is that the majority of the growth has been driven from activity because of the Fed backstopping and injecting capital into the economy. But I think that the other issue that we brought up last time we discussed was the smaller investors driving up both what I'd call really driving the volume and the prices. The folks who are investing through Robinhood and others. Did you folks take a look at that issue in terms of saying what potentially that has an impact in terms of the performance of some of the big indices that we're looking at? And is there any sort of thought or consideration to that?
I don't know if Joe, you have any specific comments on that. I mean, we have mentioned that cash. I saw a chart the other day. I don't have it right in front of me, but cash on the sidelines. Maybe to Mirza's point, a lot of the institutional investors, that cash is basically at a 10 or 15 year high at this point in time. So there is some stuff on the sideline. Maybe some more activity from certain groups of individuals, but definitely some cash out there too.
Yeah,
Well,
Mirza, I was just going to say the information, if I might. You're talking about Robinhood and that kind of investing. The volume isn't going to get to the size where they can drive it, except in a vacuum. And so you've had a little bit of that, and they've been riding the wave where I think some of the institutions have been too. That probably worries me more, just for the fact that history proves that the individual investor has not been correct. So I don't think that's got enough volume to drive it particularly, though.
Got it. Okay.
Great. Well, moving on to the actual portfolio. So this is your fiscal year that ended at June 30. The portfolio was worth $83.7 million. I will note, we began the fiscal year at about $85 million. Your payout, your spending rate, which has been consistent over the last couple of years, you had about $1.5 million that left the portfolio. So when we include June performance, you'll see that we were able to eke out an $88,000 investment gain as we look at the fiscal year. So despite all the volatility and obviously what was a difficult time period, the portfolio did come back dramatically, and we did close out the year in positive territory. So those were some of the good news. Goes back to what this committee has done over time, which is to remember that it's a long-term endowment. No need to panic. The committee did not panic and make dramatic changes when the market was down. Amy and her team worked hard to try to minimize the cash flow needed from the portfolio. So we looked at all the income coming off in addition to any additions to the portfolio to try to minimize selling positions while they were at a loss. So all of that went together to contribute to that positive gain for the fiscal year. This is the asset allocation at the end of June. So the policies up on the top and the target portfolio down below, pretty close in line. We'll notice a few areas that have, like Mr. Hickson pointed out earlier, U.S. stocks have done better than non-U.S. stocks. So slight overweight there. We did pull from some of the bonds that had done very well when we needed cash flow at the end of the fiscal year for the spending rate. So, but everything very close in line with the target policy. We'll address, what that policy should look like going forward in our next attachment. These were the results of the portfolio. Yellow bar are your managers' net of all of their fees versus the benchmarks, which of course are listed there in green. You'll see for the month of June, outperformance about 40 basis points. The portfolio was up about 2.7% for the month of June. Over on the right is the fiscal year to date, which is basically the 1 year result. You'll see that while we did eke out a positive absolute return, as I mentioned on the previous page, we did underperform the target benchmark. A couple of managers contributed to that we'll talk about on the next page. So this would be the fixed income managers. What you'll notice there is the more conservative managers like a Dodge & Cox or a BNY Global Bond held up much better in this environment when you look at the fiscal year to date time period. And then the managers that had more risk within them, a Pioneer or a Templeton Global Bond Fund, underperformed in this environment. Now, they've done better over more recent time periods as the market has come back, but in the sell-off, having high yield, having some of those other lower credit quality did underperform in that environment. On the equity side, really pretty strong performance across the board. The only areas where you see underperformance, I'll highlight over on the right, the fiscal year to date. Dodge & Cox is your international value manager, whereas MFS, the blue bar, and this is kind of in the middle of the graph there, is your international growth manager. So we've got them paired up because of growth and value, but you'll see the difference there. Dodge & Cox underperforming and MFS dramatically outperforming. But combined together, they did a nice job relative to the benchmark. One last comment for you on this page would be, you can see the growth and value there highlighted, but the managers did a nice job on a relative basis. On the far right, you'll see the red bar Brookfield. This is your global REIT portfolio. We talked about that on our last discussion about how REITs could be challenged in this environment, and specifically global. REITs outside the U.S. could be even more challenged. So we definitely have a replacement for Brookfield. In our case, probably eliminate the asset class altogether. But we'll talk about that on the next one.
So Bryce, can I ask, is there a way for you to make your screen bigger?
I can. So yes, there are a couple ways I can make it bigger, I guess.
I mean, I know the committee members, maybe, I know we all have copies, so we can look at our individual copies. That's much better from my view, Mr. Chairman. I'll defer to the committee members.
We're the same way, Amy. We just didn't want to say it.
Okay. I'm less polite than the rest of them. Thank you, Bryce.
Understood. I probably should have created maybe a slide version of this versus the hard copy, but we'll work through it. I appreciate that comment. So, we always do the summary page at the end where we talk about changes or what we're recommending. You can obviously notice that, remember, BNY Mellon during the last fiscal year, we found a cheaper share class that saved the BOV about 25 basis points. So we had moved into that. Brookfield, we had talked about the underperformance and the fact that they had been on watch. So we've talked about replacing them, which we've got a recommendation today. And then down in the alternative section, we've got a couple funds that are being liquidated, a couple that the board approved, like OrbiMed, that just recently had their first capital call. But I did think it was important to mention some changes going on with the alternatives. Historically, these are all sub-advised by top tier firms that are out there that, we spend time from our research group analyzing and the committee showing. But the administrative work, Wells Fargo has put together an alternative group that basically did the admin, made it so that it was accessible at lower dollar amounts to investors. Wells Fargo continues to look at what are the best practices that are out there. And within the most recent quarter, we sent some communication, have been working with Amy and her team. We have decided and recommended that, and there's a document here in front of you. I can send you greater detail at another point in time. But the Wells Fargo Investment Institute has decided to sell the administrative function of the alternatives to iCapital, Institutional Capital Network. I don't know if Mirza, if you're familiar with that group or not, but basically when we looked around the industry, we felt like they were the best at handling the administrative functions of basically the feeder fund structure. So if it gets approved by investors, which is our recommendation, we would move the administrative function to them. So basically the reporting, the statements, all of that information would be handled by them. We would continue to handle all of the capital calls and distributions and get any of the reporting that would be needed for the college. Also to note that all of the investment strategy, investment portfolio, the investment teams would all stay with the master fund. So there'd be no change in the fee structure. There'd be no change in how the portfolios are being run, but really just trying to upgrade what is the administrative function behind it. And we've seen many others in the industry, several of other competitors do the same thing, literally move it over to iCapital too. So did want to just let you know that was something that was going
on. Is there a change in the fee structure? Is there a change in any expense allocations to us?
Nope. All of that's staying the exact same at this point in time.
All right, great.
The hope would be that the reporting would be even better, that getting managers and all of that would move even quicker, just because iCapital is doing this 100% of the time in their scale and resources. But the fees stay the exact same. We're actually, part of the deal is part of the employees that have been servicing are actually going to be move over to iCapital. So they'll be very familiar with William Mary's account and any of the requirements or special reporting that you've needed historically. But to your point, no change in the investments, the investment teams, any of the fees, any of that. So those were our prepared comments on the portfolio. We were going to move into some of the, basically at Mirza's recommendation, look at some of the asset allocation and discussion if we want to make any changes to the portfolio. So I want to pause there to see if there's any comments or questions before I move into that forward-looking discussion.
No questions for me. Tom, Jim,
Tom,
Mr.
hi. That's a very remarkable job to bring the portfolio back to basically break even. If you'd have bet money 3 months ago or even 2 months ago, I would have bet on the other side, not to bet against you guys, but very well done.
Great. Well, so moving on to, the discussion was about how to prepare for, the unknowns that are going forward, unknowns in the markets and in the coronavirus development. Obviously, a lot has transpired in the last few months and even this summer, but the fall holds many unknowns that many of us cannot predict, including, what will happen to coronavirus. But also its impact on the college and, what that could mean for what this endowment has normally been used for. So we've been working with Amy and her team and in the subcommittee on coming up with really just being prepared for whatever would be needed. So as a refresher, we talked about this one. Let's see if I can blow it up a little bit here for you. The first discussion we had talked about previously was making sure that there was liquidity within the portfolio. So this is an exercise we've been doing. I think Amy's been a part of it for the last couple of years, making sure that the portfolio, being aware of what's liquid. So you can see in front of you with the existing portfolio, basically 94% of the portfolio would be liquid within 2 days' notice. Anything beyond that, the last 6% of the portfolio, given the nature of alternatives, would, you can see, take, anything from a month to, multiple years to liquidate. But the rest of the portfolio, basically 94% of the portfolio, could be liquidated within 2 days. So that's one thing we're keeping a close eye on, is the liquidity of the portfolio. The other thing we talked about was, if significant distributions had to be made from the portfolio. So we talked about withdrawing significant money from the endowment. What would that mean in the short run, and what would that mean in the long run in terms of its impact on income and spending in the portfolio? Obviously, there are short-term decisions that sometimes have to be made, but it does have long-term ramifications for a long-term institution like William & Mary, but those are some things that can be modeled and looked at. But following that discussion,
Hey, Bryce, quick
yes,
question. I think this 30 and 50%, it seems like just a very large number in terms of withdrawals. I think we were talking about maybe 10 to 15%. Is there a 30 to 50%? Are those scenarios that just curious on how we got to those scenarios?
Yeah, those were not recommendations. Those were just kind of, worst case scenarios or extreme things that sometimes were thrown out there as, you get that question from some endowments. What about if we had to liquidate 30% of our portfolio overnight? What would that be? Definitely not our recommendation. Amy can speak for the college and their impact, but definitely not. These were not meant to be recommendations. These were just some scenarios where we were throwing out, if you had to liquidate, there are short-term ramifications, but there are also long-term ramifications that would be impacted. So when we did our modeling that I'm working to, we impacted more about the 5 to 10% range, Mirza.
And I would just add, part of the good thing for the optimal group is that they're focused solely on the portfolio. In the discussion I think we had at our last conversation, Mr. Chairman, was the restrictions that go along with those dollars. If we were to pull the dollars out of the endowment, over 85% of those are restricted. So we would have to use them in accordance with those restrictions. So it's both what it does in terms of the long-term investment and use of those funds, but also in the short term, even though the dollar numbers can be large, the actual flexibility around those dollars is fairly limited.
So basically, to your point, Mirza, the original thought was, hey, what is an extreme example? And we came out of some of the internal discussions saying, okay, those aren't necessarily realistic for many of the reasons Amy just said. But what do we need to look at, and do we need to make the portfolio more conservative? I think if I heard your request correctly, Mirza, it was, hey, come back to us with what are some options to look at the portfolio and see if 30 to 50% withdrawals are not realistic, but what are some things that we can do to make the portfolio more conservative if we needed to? So basically, we went back to our asset allocation process. What was also helpful is in the interim here in July, our capital market assumptions got revisited or updated. That's an annual process that happens in July. So we're using, y'all are literally the first client that we've used with the brand new assumptions that are in place. You can see these up on the page right in front of you. These are our assumptions. Now, what we used, for the subcommittee, and we can do other analysis if you want to, but I think, Mirza, from the work that you seem fortuitous to have done last year, if you recall, is you asked us to do modeling based off of the next kind of 2 to 5 years, because the market was going to be, in your opinion, very different than maybe it had been over the last 8 to 10 years. I don't know if you foresaw the coronavirus happening, but clearly it's been a very different market than what had been modeled and what we all got to participate in. So what we've done is we've used our cyclical results, which are for the next 3 to 5 years. Typically, we like to use our strategic results, which are kind of over the 10 to 15 year time period, but just recognizing that we're in a unique period for a couple of years. Just piggybacking off what we did in October of last year, that really prepared the portfolio for what could kind of be worst case, which is what we did experience in March. We thought we would continue with that. So if you look at some of these returns and you're a little confused, remember they're only for the next 3 to 5 years, but they are forward-looking projections. The biggest thing that happened in our assumptions for July that we updated is that cash came down dramatically. The reason for that is obviously that the Fed has said, I think Powell's comment was that they wouldn't even think about raising interest rates. So the bottom line is interest rates are going to stay low for the foreseeable future, if that's what he's communicating to us. So we believe cash will be at very low rates, and we brought down our inflation expectation. We can spend a later time talking about all the money that's being plowed by central banks, what that will do to long-term inflation. That's a great conversation. But right now, with the demand and supply imbalances, we don't see inflation being an issue. So we've lowered our inflation target below the long-term target for the Fed. So what that means is very low returns out of fixed income. It's brought the returns down for everything, honestly, because cash and inflation are a component of everything. But you can see fixed income is going to be very low. Equity is going to be lower than expected. But we do expect U.S. to do better than the international. Some things like private capital have some of the best returns. But anyhow, all that's been modeled into our analysis. We took your investment policy constraints and the correlations, and we threw those all into our optimizer. And we came up with basically 3 portfolios that we felt like the committee should consider if you want to get more conservative than you've currently been in the portfolio. We named them just for for conceptual purposes, a domestic focus. So we've put more into the U.S., a fixed income focus, which we've increased the fixed income allocation. You can see the green here, and then lower risk, which is just moving even more conservative. We just came up with the name lower risk or low risk portfolio. So I think the best way to model this is to maybe look on the next page. But Mirza, to your comment, we basically required that each of the portfolios have a 5% allocation to cash. Historically, we've had no allocation to cash because cash doesn't generate much, and William & Mary is a long-term endowment portfolio. But with the 5% cash and the fact that the portfolio generates almost 2 to 3% in income, that basically could give you almost 2 years worth of cash for your spending rate that you've currently been using. So your current spending rate is 4 and 3/4. If you use income for 2 years plus this 5% cash, you basically would have cash reserved for your spending for the next 2 years. If that's too conservative, or if that's not conservative enough, we can remodel that. But this was us trying to incorporate what you said about, hey, let's incorporate some cash. What would that look like within the portfolios? So before I pause and get any questions here, I just wanted to show it on the efficient frontier with our new capital market assumptions. The existing portfolio or the existing policy is kind of this brown box called the target portfolio. And then we've shown the domestic focus in orange, the fixed focus, which was a proposal number 2, and the low risk, which is proposal the green. You can see where those sit on the efficient frontier relative to the existing portfolio. I'll pause there.
Hey, Bryce, thank you very much for doing this modeling work. I think this is a helpful way to lay out some options to think through. Maybe just going back to the prior slide, could you just take a minute just to walk through the differences? I know that each of these scenarios are more conservative than the target portfolio allocation that we have in place now, or the current portfolio allocation that we have now. What are sort of the key differences that you're looking at between each of them? How do we go from target to domestic to fixed to low?
Yes.
Can I recommend you focus on the table at the bottom and maybe make it a little bigger? I mean, the pie charts are really pretty, but I actually thought as we walked through it, that really helped me understand the difference in those.
Yes. And Amy, do you think this one's better or the previous table?
Either one.
Okay.
I think this table is
so I jump to the next. Go ahead.
This table is helpful. Yeah, thank you.
Okay. So let me enlarge it a little bit here to Amy's recommendation. And Mirza, you're correct. So let's talk about, these were our headings that we used, but in greater detail, let's look at something that helps you. So in general, what we did was we increase. The goal was the goal from the subcommittee was come up with some more conservative portfolios that we could move to, even if it's for the short term. So in general, you'll see intermediate taxable bonds increasing across the portfolios. As they get more and more conservative, you'll see that increase more and more. A couple things we did to get those higher. First of all, you'll notice international developed market bonds. We had a 6% weighting in. We basically zeroed that out across the board. The reason for that is we just feel like with central banks across the world lowering interest rates, here in the U.S., the Fed has said they won't go negative, but in many places around the world, they have gone negative or kept it very low. And at some point in time, the volatility, especially introduced by currencies and other things, the income you're getting is not compensating you for that risk. So we felt like that area was best served by increasing it. So basically a move to domestic within the fixed income area. We did add a new asset class called preferred stocks, which fall into the fixed income category, although granted they can be hybrid. we felt like these are mainly issued by financial institutions, banks, and insurance companies. We think, unlike the financial crisis, that the financial companies, financial institutions are in much better, their capital and their position. Even though they're going to be challenged from an earnings standpoint, we think their capital and liquidity is much better. So this was an area of fixed income that could generate slightly higher returns in addition to high yield. That was another area that we slightly increased. Where we took the money from was equity, but you'll notice that, especially in the domestic focus, we increased large cap. And we did decrease mid cap and small cap, as those areas are slightly more risky when you look at the modeling. We decreased international developed, obviously more in the domestic one, but across the board in all three models, international small cap and emerging markets all came down in those modelings. We did take out REITs. Remember, we talked about earlier that REITs could be challenged, and specifically Brookfield we needed to address. But across the board, there are some good parts of REITs like data centers and Amazon distribution centers. Those kinds of things will probably do well. But office and retail and some of those other areas could be challenged. So we did take out public REITs. We added infrastructure, which was another real asset that could kind of offset REITs. And then alternatives, we didn't adjust dramatically, but we did lower it from about 10% down to about 8%. We still like alternatives, but just keeping the liquidity profile in mind, we did reduce that a little bit. So we did summarize it down here below, where we grouped them into different categories. And you can see in general, fixed income basically increases, equity decreases, and alternatives slightly moves down. And once again, we added cash, which historically had not been a component of the strategic target. And then you can see here what it does to the expected return and expected risk. So domestic focus actually increases the return, but generally the return does go down as we get more and more conservative. But you can see the standard deviation also goes down starts closer to 11% right now and goes all the way down to 7% if you were to go to the most conservative. And the worst case return down here at the bottom is, if I can blow that up even more, that's, kind of what happens in, the coronavirus situation. You could be down almost 11%, and that goes down to 9% or down to 6%, depending on which model you selected. So let me pause there and see if there were any questions.
Bryce, looking at the change you're making, calling it domestic focus is appropriate because you've taken a lot from the non-U.S. I guess as a long-term investor, I would struggle with the concept of reducing non-U.S. so much.
So it's great that you say that, Mr. Hickson, because a lot of investors just look at the last few years and they will say, man, this is, U.S. is the place to be. And we agree with you that over the long term, you're going to need an allocation to international stocks and bonds. So we agree with you 100%. I think what we would say is if you were to move to something like the domestic focus, it would be something that we'd be more interested in you doing for the shorter term, the kind of 2 to 4 year time horizon. And then eventually we would want to, like you said, move back out to more international. We also would recommend in the long run not having a 5% allocation to cash. But once again, in the short term, if you needed that just because you didn't want to liquidate things, that would be okay in the short run. But that would definitely not be something that in the long run for a long-term endowment portfolio, we would not want a strategic allocation to cash much more than 1 or 2% if you had to.
No, I don't think we want that either. I think we'd take it back down to where we are. But I think it's, I don't know, it feels like more like you're trying to time the market if we're talking a 2 to 4 year with a shift from non-US to US, but just my thought.
Maybe I can add a little bit more sort of nuance to Jim's question, just to further help us sort of understand this. I think when you talk about international bonds, especially in the emerging markets, rates going to zero and perhaps going negative sounds about right. So holding an asset that's giving us a negative yield doesn't make a heck of a lot of sense. So, but I think to Jim's point, a lot of the gains are going to come from the equity portion, whether it's international developed markets or the emerging markets. And taking that out of the equation doesn't sound about, gives both Jim and myself pause, saying, if I'm going to look at it from a long-term horizon perspective, I would say, we may be sort of being too conservative in our approach in terms of pulling that out.
Right.
So I think that's any asset that's giving us negative yield should be taken out, period. I think there's no asset allocation policy that I've seen that says that we should hold on to something like that. And I think, Jim, you would agree with that. But I do think.
And these three were just samples, just trying to make them wide enough apart from each other so you could tell a difference between them. Absolutely, if the subcommittee has a specific thought, either you want us to go back and rework it, or if you just tell us use this number, we're happy to customize any of these for what the BOV would prefer. So if you say, hey, I like elements of this one, but I like elements of this other one, just tell it to us, and we're happy to. It's a quick run of the numbers and get it back to you.
Yeah. Look, I think the other point that Jim is making, which is I think we should all pay attention to, is we're not looking to time the market. If we wanted to time the market, we would be having an emergency meeting back in March or late February saying, here's what we need to do. Clearly, that's not the case. There's no knee-jerk reactions here. And over the last 2 years, I think we've seen that. We've been sort of stepped back and said, but there is a Jim and Tom, there is some big macro changes that are taking place. And we need to be cognizant of what's coming for the next 5 to 10 years, these sector tailwinds that are taking place. And we would be burying our head in the sand if we're not attuned to those. So I think some of the pieces that I think Bryce and team have highlighted with respect to infrastructure spending going up and things like that, I think that makes sense for us to say, okay, great, real estate by itself, we think may not do as well, but we know there's increased infrastructure investing that's taking place, that's already in play or will be in play shortly across the board, or increased infrastructure spending, and therefore we should be increasing our exposure to that. That to me also makes sense. So, so Bryce, I think on the international piece, I think you're hearing from both Jim and myself the same concern, but maybe with a slightly different take on it. But I think on the infrastructure and REITs, I think I'm not sure there's a lot of disagreement with what you've put into place here. Tom?
Yeah, I agree with you, Mirza. I like the concept here of some different slants to both the domestic, sort of getting out of the international or reducing it doesn't feel right, and going more fixed income. I'm not sure about that. The one area that I'm very, very concerned about is commercial real estate, which you guys have commented on. There's some good areas, but boy, I think that's going to be a major dislocation for investors over the next few years. I mean, people working from home is going to be, we're going to see a lot more of that. So if you own a bunch of, I think you guys would say, if you own a bunch of office buildings in downtown Manhattan, have a nice time. It's like owning retail mall space right now, I would think. So I like the exercise. Whether this is the right time to reallocate for considering where we are from a pricing standpoint, I'm not sure about that, but I really like the exercise.
Oh, could I just add, I think, we went through this exercise at your request about being more conservative in the mix, and you have within your guidelines, as Bryce started out showing you the bands, you wanted to be out of something, you could probably adjust the bands for that, right, Bryce? You could hold some, make a decision to hold some cash, anticipating what you might be doing, what the college's needs are, and really just refocus on rebalancing and adding a couple of those asset classes, even like, you could add preferreds in here in some way if you wanted to, or the global infrastructure, just to change it up. And I think you'd find that would keep you on track with the same kind of growth without having to make a dramatic change to any of these samples. But just a thought.
Okay, I think a really good suggestion, Joe. So I do think we should add those categories, the preferred, the global infrastructure. I think those are useful categories for new categories that are emerging. And to Tom's point, every asset manager in the PE space that we've looked at is renegotiating all their portfolio company leases, or is having discussions to renegotiating their commercial leases. And it's pretty dramatic in terms of what's taking place out in the marketplace there. So perhaps maybe another cut at this, Bryce. I think in terms of what we're requesting and seeing how that plays out in terms of what we should expect on the go forward. But
great, we will take those suggestions and kind of work up a new suggestion, and if it's okay, we'll send it out via Amy to the subcommittee.
Mm-hmm. I think that makes a great deal of sense.
Hey, Bryce, I was just looking at it. Looks like you take your U.S. and non-U.S. It's U.S. is under the target is 31, non-U.S. is 21, and you make it a 41 and 6. And I think I kind of like the current ratio as opposed to.
Great. Okay, we'll try to keep that same ratio similar. And are y'all okay decreasing or maybe eliminating international developed bonds?
I think that makes sense. I mean, I think unless we all do something in the next 5 to 10 years.
Okay, great. We will work that up.
Sorry, one other thing. On the alternative side, alternatives have outperformed every other asset class across the last 3 decades, or certainly across the last 2 decades. So decreasing that, again, to Jim's earlier point, it doesn't quite feel right.
Yeah, well, we certainly would agree with you. We'd rather have more than less. Remember, the request was to come up with forms of liquidity.
Yeah.
That's what was driving this exercise.
No, I think
changing the exercise.
Yeah, absolutely right, Joe. But I think what we didn't understand was that 94% is available to us at any time. That's number one. Number two is us saying, like, we'll set aside some cash just in the interim shorter period. We are going to go through a tough economic period over the next 24 months, regardless of when the vaccine comes out or does not come out.
Right.
But we clearly have to be thinking about it for the next 10 to 15 years rather than just the next 2 to 5 years.
We totally agree with you. We'll put it together for you.
So maybe a quick question on that cash, because once again, we pulled 5% out just from our previous discussion. Is that a number is that too high? Is that too low? Is that something y'all feel comfortable with? Once again, the idea of 5% was you've got about just shy of 3% in income each year that gets paid out of the portfolio that automatically pays out. So over the next couple of years, you've basically got 6% coming from income, 5% in cash. So you've got,
Before I answer that question, Bryce, what's the expected returns? Like, is this the arithmetic?
So that's a great question. So it's right down here at the bottom. So based off of our capital market assumptions for that, cyclical 3 to 5 year time frame, you're only looking at 4 to 5% returns coming out of the portfolio, which I think is Mirza is your point. We also did some modeling on the next page where we took each portfolio, we run it through our Monte Carlo simulation, and there's a little table down here at the bottom. But basically, we say, hey, how much confidence we have in hitting basically a spending rate. And in our case, 3%, anything above 50, we feel pretty confident in. So obviously a 3% spending, we feel very good about. A 4%, we feel pretty good about. You get up about 5% or any higher, and we think you're going to be challenged given our view of what's happening over the next few years.
So just hold that thought for a second. The reason for 5%, at least that was my suggestion, I think initially, was because if we do need liquidity, we don't want to, and the reason we would need emergency liquidity is when things have gone wrong, right? Or something has gone wrong. Amy and team are calling you folks up and asking you folks to liquidate something. And that's when asset prices would be not necessarily at their highest, probably at their lowest or somewhere headed down. So it's for that exact reason. And if you go back down to that slide you were just showing us, right? So in that case, it prevents this scenario where you are talking about that taking out, taking out cash because you're either allocated or and you're going to hold for the long haul, or you're not worried about the short-term target return. You're worried about the long term.
Okay.
But I think really it's the question for the rector and Tom and Jim.
Well, I think that I agree with you that, if there's an emergency and we need cash, that's not the time to liquidate. So I think I'm comfortable in the short term having a 5% allocation to cash. And if things calm down, we can certainly shift that to other investments.
Okay.
Yeah, I can live with that. I'm thinking about 5% versus 94%, but you're right. The time frame is what we got to think. I hate to hold cash when we're trying to drive return, but this is an uncertain world. You comfortable with everything we're saying, Amy?
I am. And Bryce and Joe and I talked about some higher percentages. I really don't. This wouldn't be where I would go for cash if we needed it in an emergency. Right. I think 5% gives us enough headroom.
Right.
And it is the right move short term, and we can always, as you said, go back and invest.
Okay.
Yeah, I agree with that.
So the last thing we had is when we make some of these changes, and once again, our job is to come back and take the feedback from the subcommittee and rework a recommended allocation for you. But based off of the discussion we've had and the analysis we've done, we are going to need to make a few manager changes to the portfolio. In the interest of time, I don't know if you want to go through every one of those, but in the back of this book, we have, starting on page 20, we've kind of shown you, we did it for each portfolio, but once again, we'll come back with a recommendation, specific to what you want. But the recommendations are generally similar in terms of needing to add some new managers or delete managers from the portfolio. So we basically prepared that without knowing what the final allocation would be. And since we've got everybody on the call, we'd be happy to quickly go over that if that's of interest to you, Mirza.
Sure, I think it'd be helpful. I know there's some rework that has to get done, but please, yes.
Okay. So I might have Karen weigh in on a couple of
one quick thing. I realized we had until noon allocated for the time for this meeting. Before we dive into that, do we have time, Jim, Tom, to sort of bring
this that's fine. So I'm fine to go on. So Bryce, one thing on the managers, just my thought. You guys know these managers. You have confidence in them. Whatever. I always feel like when the formulaic, tells you one thing, but the gut tells you, not sure I want to do that. I think that's where the science meets the art. And I would encourage you all, as you express your views going down this chart, to tell us if you just don't feel right about trimming or cutting a manager because they're good. That may be too soft side for some people, but this is where your expertise and experience becomes operative, I think.
Okay. Well, great. I mean, I'll quickly walk through, in the next few pages, we have a lot more detail where we basically summarized our best 2 to 3 managers in each category. But on this page, we basically told you what our gut and what our analysis is showing. And once again, if the committee would like to be more involved in that discussion or has a specific opinion, then we'd be happy to look at some of the other options. But in general, if fixed income is going up, we talked about basically in all of those models, increasing fixed income. You have 2 managers right now, Dodge and Cox and Pioneer. We would want to add a third manager to the mix. So MetWest is our recommendation. And so we've got some slides on that, but that was what was going on there. We think we can get the high yield exposure from the existing managers. So we don't need a dedicated manager there in that area. We would be selling the 2 developed bond managers. If we eliminate that asset class or maybe we reduce it down, we'll take some look at that. Preferreds, the manager we were recommending was Principal. That would be a brand new allocation for the portfolio. So there's only a few managers that do that well. Principal would be our recommendation there. The large cap is going to take a little bit of conversation, so I'll pause there for a moment. I mean, I'll come back to that one. But down here, we'd be getting out of REITs, as we talked about, those 2 managers. Nuveen had done well, but once again, if we're eliminating the asset class, probably makes sense. And Lazard would be our manager in the listed infrastructure space. Once again, that's a brand new asset allocation or new asset category for the BOV. So really the 2 topics I wanted to spend time talking about was the fixed income and the large cap. We talk about each of the managers here within the fixed income category, but in the interest of time, MetWest is the manager that we decided to add to the 2 existing managers. MetWest is the green bar that you'll see here. They, I think, just got nominated as Morningstar Manager of the Year or something most recently. They've done a very nice job, managing through this environment and other time periods. It's a long-term track record. So I actually feel fairly comfortable with that recommendation. PGIM was the other manager. They're a little bit riskier than MetWest is. But ultimately we lean slightly towards MetWest. Karen, any other comments you had on the fixed income?
Yeah, fixed income fund searches are easy and fun because this chart's showing you that the gray bars, those are the percentiles for the universe, and that little black diamond is the benchmark. So almost all active fixed income managers can outpace the benchmark. The question, as Bryce was alluding to, is just how are they doing it? Are they taking on a lot more risk or a lot more incremental? And yeah, I think MetWest is a conservative way to add value, but not get too far over our skis. And
any comments on the fixed income before we move to the large cap? Once again, MetWest was our recommendation there. PGIM would give you a little bit more return, but also a little bit more risk. Right now, Pioneer does that. So we were just trying to find managers that were complementary to the existing lineup.
I'm fine.
Fine as well.
Okay, so the other conversation was large cap. Right now, and it might be easiest to jump to this page right here. So right now you have BlackRock, which is the orange, your large cap value manager. They're supposed to be in the value category. This is value on the left-hand side. This is core in the middle and growth over here on the right. The chart goes large cap, mid cap is where the horizontal line is, and small cap is at the very bottom. So BlackRock is exactly in the large cap value place, which is what we've hired them to do. And then you also own the yellow dot, which is the Vanguard Russell 1000 Growth ETF. So it's a passive vehicle. So you've got growth and value pretty much split 50-50 at this point in time. If we increase the allocation to large cap, we were thinking about adding a third manager. You could just give it to the two existing managers evenly. But another thought we have, depending on what allocation we come up with, was, does it make sense to add a third manager to the lineup? So we introduced two managers to you, ClearBridge, which is the green here, and the blue, which is Poland. Ultimately, what we're recommending to you today, unless you see something otherwise, is to look at Poland, which is the blue manager. They are an aggressive, and maybe Karen can talk about their style a little bit, but something to keep in mind is if we add them and you already have the Vanguard, we see it as a complement because one's active and one's passive. But you may want to, if you add Poland, if you want to make a big bet on growth, then you keep both of those and you be overweight growth. If you want to keep a little bit more balanced approach, where if you think value is going to come back in favor here at some point in time, then what you might want to do is replace the Vanguard with the S&P 500, which is the purple here in the middle. And then you would have a value manager, a core in the S&P 500, which is passive. And then you'd have the active manager over here. If you want to have a big bet to growth, which is what's done well recently, if you see that continuing, then you may want to keep both these managers. But let me have Karen do a quick comment on Poland and why we like them. And then I'll get the committee to weigh in on if you want to buy the S&P 500 and balance it more, or if you want to overweight growth more.
Yeah, and the reason that we like both Poland and ClearBridge feeds into the earlier questions you all were asking about what's changed about the economy and what's new. Both of these managers are what we would consider very concentrated managers. So they're only going to invest in, Poland holds about 20 stocks and ClearBridge is a little bit more, like 50 or 60. So they're being incredibly selective, which we think is very important in this current market environment, which is also the reason that we would suggest moving away from just the Russell 1000 growth, where you're going to have exposure to everything. Poland has done incredibly well over a rolling period for its whole history. They did have some change in ownership or structure 8 or 7 years ago when the founder passed away. So there were a few years that we were a little concerned whether that successful track record could be carried on, but it certainly has. He had trained the folks that worked with him to carry out the strategy very well, and we've not seen any change in performance since that occurred. So ClearBridge, the slight advantage to that would be that you can see on this page, it can go into the mid and small cap areas, which, as Bryce said earlier, that's a lot riskier, we believe, but it gives them a greater opportunity set. So just a positive for ClearBridge, but we do still give the edge to Poland.
So maybe some input from the committee on, if we add a third manager and it's Poland, do we want to keep the overweight to growth, or would we like to purchase the S&P 500 instead of the Russell 1000 growth to keep a more balanced approach within the large cap?
Well, if you'd purchased the S&P back in March, I'd be much happier, but.
No, so insightful, Jim.
Yeah.
Well, I did, so everybody else should have. Anyway, I think I like the S&P. I think it's, we're always trying to meet or beat the benchmark, and I never have a problem owning the benchmark. So.
I defer to you guys. This is what we pay you to make calls on, and I defer to your recommendation on this one. We want both. So you tell us what you recommend, and I would be comfortable with either. I don't think we ought to micromanage this one personally.
I'd agree. I think having that mix, that balanced mix of the value benchmark and active growth makes a great deal of sense.
Okay, great. So, the others were like I said, we showed you 2 managers in infrastructure and we showed you 2 managers in preferreds, but we've gone ahead and, recommended the manager in each that we recommend. So in the interest of time, I mean, that material's there, but they're both recommended managers by our research group that goes through a very exhaustive process. But in the interest of time, I won't spend on it today, but we are recommending Lazard in the infrastructure and Principal in the preferreds. So those were our comments. I know we ran over a little bit there, but a lot of changing parts going on. We know our responsibility is to take some of the input from the subcommittee, come back with a recommended portfolio and get approval for that. And we'll turn that around in very quick time.
Great. Well, thank you very much, guys. I appreciate it. There's a lot of work done in a short period of time. I know we met 3 weeks ago, just having an informal discussion on what's happening, and you folks have turned it around and presented something back to us. That's very helpful.
Thank you very much.
Welcome.
Thank you.
Amy, is there any other topics that are to be discussed now? Or
Not for today, Mr. Begg. I know it looks like the rector may have had another appointment, but I know he's actively working with Mr. Fox. Likely that we will have a finance committee meeting in the coming weeks. Certainly, if not, working through executive committee or board. So I think future topics in the offing, but for today, I think we got what we needed.
Great. Is there a motion to adjourn?
I'll move.
Second.
All right, we're adjourned. Thank you very much, guys. Michael,
Mirza.
thank you again on the Optimal Group. As always, many thanks.
Great job.
Thank you. Appreciate it.
Be well.
Safe.
Bob.
Bye-bye.
Bye.